simple framework that we created for people to kind of understand how to implement it or think about it. So the idea of like smart liquidity mining or liquidity mining 2.0 was really brought up almost immediately after we had talked about KPI options. But we never really pursued it. And I think maybe at one point we spoke to Sushi about it as well, because they were kind of going through their whole sushi vesting discussion, and we even brought up the idea of possibly changing maybe future sushi rewards to have some kind of a KPI element to it, or even just a call option element to it. But it never really went anywhere, and we kind of left it aside. But with layer 2 solutions being launched, we thought it'd be a good idea to really bring it back up. And I have a feeling that there may be more mining programs or incentivization programs that will start to come up again once you start seeing a lot of these L2 solutions come back up and people wanting to kind of really fight for volumes and for TVL. So that's really where the idea came from, why it came back up. I think talking to a lot of people about the idea, I think we got very good feedback. Everyone's very receptive to it. They think it's much better than the current way of farming or liquidity mining. I think there were a lot of questions about, how do you implement it? So a lot of people obviously don't really have time to think about these things. So that's the reason why we decided to kind of put something together and try and just think of a very simple framework for people to just have some kind of a base idea of what a program would look like. So we can jump right into it and kind of look at what we created. So the idea for people who haven't really read much about liquidity mining 2.0, the idea is basically, instead of just paying tokens to farmers, you're paying either a KPI option or a call option. And in that way, farmers don't actually get their tokens immediately. They'll need to wait some period of time, say for a month, before they can redeem these KPI options or call options for actual tokens or the native tokens of the protocol. I think this accomplishes a few things. One, there's this vesting period where they can't access those tokens right away, so they can't sell it immediately. And then two, I think, which is more important, is that it really causes the farmer to stop and actually think about the protocol. And if you are, in trading, we talk a lot about how if you want to learn about something, or if you want to learn about how something trades, or you want to understand about a stock, the best thing to do is really to have some risk on. So if you have a little bit of that risk on, your eyes are glued to it, and you start thinking about it and reading about it and trying to understand it. So it's the same thing with, like, if you are trying to, I don't know, lose weight, or if you're trying to like achieve some kind of running goal, if someone just places a bet with you, a small bet, and you have a little bit of risk, you're suddenly more engaged, no matter what amount that is. So I think it's the same idea, where if you have that risk in your wallet and you can't sell it, then you end up watching it, and you end up trying to figure out, what you can do to make that succeed, or you want to understand, what it is that you have there. And I think right now, not a lot of farmers are really doing that. They're just basically finding the highest returns, and then they're getting those tokens, and they're immediately selling it back out just to convert it back to a stable coin or to one of the majors like ETH. So that's really the idea. And then I think adding the KPI component to it really drives that further, where people want to understand, how they can achieve that target, and maybe potentially even join the community and figure out, what they can do to drive that target higher, and then also get paid more with it. So I'm going to share my screen. Can everybody see this?
Yeah. Yep.
Okay. So what we did was we tried to we took the balancer liquidity mine program on Polygon, and first we just basically got all the details for it. So they announced it. It was a $10 million program. They had three different types of. Oh, sorry, I'll zoom that in. A second. Is that better? So it was a $10 million program. Great. It was a $10 million program. That was paying a combination of balancer tokens, mag tokens, and Sheet tokens. And what we decided to do was we tried to design a better program around this using KPI options. And to start off, I tried to build a framework as to how people should think about it. I think the first thing that people should think about is, what is like the base case scenario for balancer. At that point in time, using DeFi Llama, or you can use basically a lot of different kind of analytics. Balancer had about 1.5 billion in TVL on Ethereum. So how much TVL should they have on Polygon, say after a couple of months? And the best guide for that was really a sushi swap. The sushi swap at that time had about 2.7 billion on Ethereum, and then about 670 million on Polygon. We basically took that same ratio. We could figure out, roughly an idea of what would be kind of a baseline case or a successful case for balancer, and that was about 369 million using that ratio. So with that baseline, then we could think of that as if balancer had just paid straight up balancer tokens, like just one token, 1 for 1, and they had achieved the 369 million of TVL, then they should have been happy with that program. So we can build our KPI option using that base case, meaning our KPI option would return 1 balancer token if they reach this target of 369 million of TVL. But then we go down here and we basically create that. So we gave the farmer a little bit of an edge. Instead of 369 million, we made it around 300 million. So all they had to do was achieve 300 million, and they would receive 1 balancer token. And how I actually did that was I had to create a floor and kind of like a cap of of what this TVL could be, and also a floor and a cap of how much we would pay out in terms of balancer tokens. So basically, I just made up numbers. I said that, no matter what, the farmer would get half a token. And at the peak, no matter how high the TVL got, they would get paid 1.5 tokens. And then using that, I basically created this kind of a linear payout schedule. So 300 million would equate to 1 token, and then 100 million or less would be half a token, and then 500 million or more would be 1.5 tokens. And then if you compared it to their current program, this is weekly number. 1 second. So if you compare it to the current program, the weekly numbers would be 25,000 in their current program versus these numbers, dependent on the different TVLs being met. You can see that there's like a bit of a scale. And then from there, you could basically put this all into a payout function, which kind of looks a little more complex, but it really is this simplest form is this linear payout between these two ranges is all it is. But the payout function ends up looking like this, or floor payout plus TVL ratio between the two. And then finally, I just decided to put this into a scenario analysis where I created some kind of a base case scenario, TVL, and then also had a faster scenario and then a slower scenario. And the numbers actually don't move much here because I created, the one other thing that you need in your KPI option is really an expiry. So I decide to make the expiry just basically pretty wide in terms of how they all expire. You could do different things where you can do a weekly expiry, but then you would end up having all these different KPI options created every week, which was kind of cumbersome for the DAO. Or in my case, I basically made them near to the next month. So for example, if you were paid a KPI option in July, you would expire at the end of August. And that's when I just kind of fudged it. It was at the end of June, so I made this also end of August as well. So then all these July paid options were all expired at the end of August, and all of these August paid options would all expire at the end of September. So there's a bit of a trade-off here, like I think, because in one case it'd probably be more beneficial or more precise to have everything done on a weekly basis. So you can imagine like an option that expires exactly 1 month from when you get paid, or 1 month from the week that you get paid. And then this would kind of, it would basically help with a couple of things. One, it would prevent a lot of rewards, or avoid having a lot of rewards come out all at one time. So right now, everything would be redeemed on August 31st, and you can imagine a lot of tokens coming out at that same period of time. So basically 1 month of payments given at one time. And then, so then if you did it weekly, then it would just be a week by week. So instead of having that many tokens come out in a month, at the end of the month, you would have basically tokens paid out each week. But I think that the downside to that is that then these would not be tradable. So if there's a possibility of wanting to have a secondary market, having weekly options on everything wouldn't really work. Like people would not basically create a market for this at all. Even with these monthly options, I think it's still going to be tricky for people to create these markets because they do expire quite quickly. But there's definitely a possibility that someone could create that kind of a market for people to trade them. In any case, so then this basically, that's what creates these. This is what I based the time frames on, and you can see that in the base case scenario, we go from 250 million to 350 million from end of August to end of September, and then in the fast scenario, we do a 300 million to 600 million, and then there's a slow scenario where it's only 150 million to 250 million. And you can see, and I think one thing that'd be interesting to show the DAOs or any kind of project that is considering this program is to basically compare, how many tokens you would end up using for your program. So in the current program, they would have paid 250,000 tokens. In the base case scenario, I basically made it the same. It's 250,000 tokens, and with that TVL. In a faster scenario, you would have paid more, and then in a slower scenario, you paid less. And then also create some kind of a dollar amount to that, given the price at that point in time. And it gives, I think this, to me, it helps them really compare and think about, potential, treasury management in terms of how many tokens they're using, and if they actually achieve their goals, then they're willing to pay more, and if they don't achieve the goals, they end up paying less. So I think it's a much more efficient use of their treasury by structuring it in this way. But I think at the end of the day, I think it's not necessarily just the cost in terms of tokens or money that's the real benefit. What you can't really track is really the community engagement. And I think that with our KPI options, that was really the big benefit that we had. We effectively created the superhumans out of that, or we created a much stronger community that was much more engaged. And I think by doing something like this with KPI options, I think people can possibly achieve the same thing. You have much more engaged people that had no idea what they were actually farming. They may actually become much more interested and then end up being a community member. So I think there's an efficiency cost or benefit to it. And then there's also this kind of, outside fluffier benefit to it where it kind of builds a community in a way that you may not be able to track immediately, but you'll see the long-term benefits later on.
Kevin, I have one question. Have you
Yes.
analyzed this from end user's perspective? Because intuitively, I would assume this type of program also would, to some extent, stabilize APRs for end users. Because not normally what you have when a TVL grows, the APR drops for end users. But here, at least unless you reach this cap, there is some mechanism actually to stabilize these APIs for miners' perspective, and maybe to some extent this could even attract more miners for such program.
No, I totally agree. There's no program that's really been implemented yet, but that is definitely a benefit. As the TVL grows, then your payouts grow. So then your APRs will kind of stay more stable. I think the only downside to that is that it takes a little more time. I'm not sure if it will, but it could take more time for it to grow. Because then initially, people may expect that you get paid less because the TVL hasn't grown yet. But I guess you can always calibrate it with the base payout. So if you're getting enough in the base payout anyways, that it provides a decent return, then people will come in anyways to farm and provide liquidity, and then it'll basically grow from there. But yeah, you're absolutely right. There's some kind of stabilization mechanism for farmers there, and yeah, I guess maybe in some ways we should probably even advertise that more, or the project should advertise that more once they do this program.
One question I had is like, I totally see the advantages from aligning incentives and trying to stabilize APY and like all the positives. But one downside that I see with this, which maybe we should put some thought into how we can build better tooling around it, is the burden for the project, for the actual DAO that's running this program is more complicated, right? They're like taking on smart contract risk. They need to run like LSPs, they need to do the token distributions, and they might need to like also do some of the stuff that we set up with our system, like the Cloudflare system for actually getting Merkle trees. If you want to actually use a distributor, like depending on how you do the distribution, right? Like there's additional stuff you have to do. And from the user's perspective, they now potentially have multiple different tokens that expire and they have to do redemption. So there's definitely a trade-off from a user experience for both the DAO and the user. So I think we should try and think about like what tools could we build to try and like maybe abstract away some of this complexity for users. So maybe it's like something that can like hold a bundle of of tokens from the user's perspective, where you could stake these like multiple KPI option tokens for like a number of weeks or something, and like do like batch redemption, or I don't know. I think like it definitely warrants like further thinking from both sides of the DAO and the user's perspective. Like how can we smooth out some of the hurdles and the gas costs and all these different like downsides that this has.
Yeah, I definitely agree. Because when I think it was with Barnbridge when we started talking about it, some of these things did come up. And I think right now I felt like we were much more just accommodative, because we were just saying like we would do a lot of the heavy lifting to help them out. And I guess we have some experience with our KPI options that we could provide some of the, I guess, like ways for them to fork what we have. But maybe if this becomes a bigger thing, maybe we need to have better tools for it. And maybe we could have just one place that everyone could just redeem any of these options.
Yeah.
Like kind of like our Umaverse, right? Where there could be just a KPI redemption type page where people go in and then you they recognizes which KPI option you want to redeem, and then it just immediately redeems it.
And I think also following on from that, like, how do you envision, and maybe this was like in the article and I didn't fully grasp it when I read it, but how do you envision like allocating the tokens based off of a specific action? Like, is it like the synthetics like staking model where you stake LP tokens, or like it's the same way that Curve would do this or any of the other major systems, or is it like a retroactive thing where at the end of the period you allocate them and then use like a Merkle distributor? Because I think there's also some like advantages and disadvantages with different ways of doing that. So how do you actually envision like the allocation of the tokens, actually getting them to the users?
I don't know actually. what like what you mean by allocation is it just like how you distribute them, or like
Yeah,
how
so
you
like
allocate? Yeah.
so I would like add liquidity to balance or whatever, right? Like
Oh,
right
sorry.
now,
Yeah.
yeah.
I thought so. So in our mechanism, like right now, we would just airdrop them to people, right? So then you're thinking of just changing that, like as in like how you would claim them from like I don't know, like a sushi spot where you have to go. No, actually, wait. You're claiming them in which way? Sorry.
So on like Balancer right now, and with our
Yeah.
KPI options, that we use the Merkle distributor. So like
Yeah.
the user would actually claim those, but there's like discretized periods over which you consider liquidity provided, right? It's like maybe once a week we update this thing, for example, like in Balance's case.
Yeah.
So it's not like it's different to sushi, where in sushi you could go and like, for every block you accumulate a certain amount of
Right.
rewards which you can then claim, that's like the synthetic staking contracts.
Right. Actually, yeah, I don't know. I'm not even. I wasn't exactly sure which way we would go for it, to be honest.
Yeah, because like I guess the point that I'm trying to make is like the tooling that we built for our KPI options, like there
Yeah.
could be a world where if this takes off, we could generalize that, right? So like any project could like use this generalized UMA KPI distributing thing, right? Where like you define the cadence, and like obviously there's a lot of open questions, like how do we coordinate correctly with like what are the payout structures, like who calculates this, like all these kinds of things, and how do we do it in a permissionless way. But
Right.
yeah, like that would be an example of something like a piece of tooling that we could build so that like teams don't have to build that, because that was like actually quite difficult for these projects to build. Like Balances one was quite complicated, and there's all these different things. So that in conjunction with like a front end, I think could definitely like make the barrier to entry like a lot lower for people.
Oh, I see. But you couldn't just take whatever distribution mechanism you're using and just plug in these tokens in there. Like what? Like obviously I'm not very technical. So then you couldn't just replace, like say like with synthetics, it's an ERC20. Like couldn't you just replace it with this KPI option instead of paying out synthetics tokens? Or if with Balancer's case, you could just replace their Balancer tokens and pay up KPI options. Are they all just all compatible?
I definitely think that you could, and that they are compatible. But they're definitely like also trade-offs here, right? Like like maybe one system is better for some projects than another. And also if you don't already have a liquidity mining program, right? Like maybe they're going to be new projects that want to run this as well, and then they'll need this tooling. And that also doesn't solve the redemption problem, right?
Yeah, I see what you're saying. Basically, if we created a standard that said, this is the standard that we would use for KPI options, this is the standard for redemption, then we have a whole package, basically like a packaged product.
Yeah,
and people could just use that, and then everyone would be just using the same thing.
And equally, I don't think we have to force people to distribute them in a certain way, right? Like if you want to use a certain technique, then that's cool. But yeah, just trying to think through like the barriers to entry for like maybe new projects as well. So
right.
But yeah, if you're an existing project, then it's pretty easy to just swap out the token.
Right. Sorry. Yeah, I was thinking just of the existing projects, but yeah, you're totally right. If we had a complete like packaged product, then it'll be much more appealing to a lot of different people.
This may be like a by design thing, but as like if I were a farmer, I think one thing that would make this less appealing to me than other liquidity mining programs is the fact that like I now like don't exactly control when I sell my risk or when I get out of the, like basically I have to wait on this thing to expire before I can actually get out of my position. And like going through the expiration process, as Chris mentioned, is like not entirely trivial. So like, is there a way, would it make sense for these projects to say, okay, well, like if you don't want to wait for this thing to expire, you're guaranteed to get at least, we know that the base payout is going to be like, let's say 0.5 BAL, right? And so we just say, okay, well, like you can redeem it anytime for 0.5 BAL, but you have to wait for expiry if you want to get anything more than that, or something like that. If people want, because like, I feel like a lot of farmers, like you said, like are used to this mentality where they kind of farm and dump, which I get that like projects don't love that, but farmers really like that. And so there's a bit of there's a possibility here that like these liquidity mining programs could be hurt by the fact that farmers are just less interested in them because they don't want to get illiquid tokens. They would prefer to just directly get a project token they can go off and sell whenever they want.
Right. Yeah, that's definitely a concern. And so there's, I think, multiple angles of looking at this. Like maybe for some projects, maybe they don't care. Like as in they want more committed people, or they want farmers who are open to understanding their project. And maybe that could be a naive thing about, but I think that's a possibility. The other thing is like if maybe the initial programs that start off would be much more attractive, like or have this much higher upside that's kind of hard to resist. So then farmers may want to get into that. And I think it may take time for these farmers to change their minds or for other projects to get comfortable with it. But like if everyone believes that this is the better way of doing liquidity mining and farming, then over time this may be the main option that they get, because every project will start to adopt it and just understand that it's better and not be fearful of losing these kind of mercenary type farmers. The other thing is that I do think that there should be a secondary market for this. So if the base is say half a token, there should be a pool that's out there that's created, and someone will just buy it from you for half a token and then take that free option, especially if they are going to be a long-term holder of that project token. So yeah.
Yeah,
Sorry.
I agree. Yeah, I agree with that, Kevin. And I just wanted to maybe add one extra point to that. And I think of it slightly differently, but in the same line, is that if KPI options allow like a protocol to pay for the outcome that they want, and so if you want to increase the liquidity of your pools and you don't reach that specific metric using KPI options, you only like pay for what ends up being the result, right? So if you want to get $10 million in the pool and you only get 80% of that, you're only giving the rewards that is commensurate with 80% of the result. And so like with that in mind, the teams giving out the rewards will be way more incentivized to increase the rewards, because those outcomes with the associated rewards is, it's like they're stoked to do that because they're getting the outcome that they want. So actually for like a farmer, the trade-off might end up being, all right, I have to lock up my capital for a while and that's the risk, but I actually might end up getting more rewards because the KPI gets met. And so it's a slightly different like dynamic, but it could end up being more beneficial for the farmer if the DAO is really willing to reward that type of behavior.
Right. Yeah, I think it's just like a breaking of habit, because like I think everyone's used to doing something one way, but I think it is beneficial for both parties, both the project and the farmers, but they have to change the way that they operate, I guess.
One other thing I wanted to ask is, in the example you gave, or the example you showed, where there was this like multi-party or multi-DAO funded liquidity mining program, right? So like you will earn multiple tokens. And like this is pretty common, right? Like on Convex, you earn like 3 different tokens, and sometimes it's more. The way that we've got the LSP set up right now is not actually compatible with that, right? Because you would need like, you can only do this with 1 protocol token, is what I'm saying. So when you have like these cooperative systems where you have like multiple project tokens that are all paying out at the same time, we might need to think about like some sort of wrapper, perhaps, where there's like an extra step where you take your, 1 Bell, 1 Sushi, 1 Matic token or whatever, we wrap them into another token, and then that token goes into the LSP, and then at redemption, it will like automatically unwrap them for you. So you can still get a bundle of tokens on both sides.
Right. That's interesting. Yeah. We thought that it would just be 3 separate, because actually this was a possibility on Polygon with FarmBridge, and Matic was going to be involved too. So So we thought we would just have to have 2 separate tokens, but I guess, yeah, if you could wrap them, that'd be even better. And you can do it all at once, and then the package comes out. But yeah, I would.
Yeah, my main issue with 3 is like then you got 3 redemptions, right? And
yeah,
I don't
exactly.
know. That's pretty
No,
painful.
totally agree. And is that something that's difficult to do?
I don't think it would be too difficult. I mean, it would be like a different
I feel like
flavor
I'm
of the
asking the wrong
LSP,
person.
but
You say everything is easy.
I think it would be possible. Matt, do you agree it wouldn't be too like conceptually difficult to do that?
Sorry, I jumped off for a minute. What? Can you repeat what?
An
trying to
LSP
do?
with a collateral token, where the token that is collateral is a bundle of other tokens. So maybe it's like 2 or 3 other ERC20s. So we would need like some sort of wrapper. And the goal is that if you ran a liquidity mining program, which was like a collaboration between multiple DAOs, you could like use this collateral token that's a bundle, and then when users redeem, it will automatically unwind that LSP and then send you like 3 tokens. So we would need to create some sort of wrapping token, and then like facilitate some additional action on the redemption. So I think like we could create a smart contract that could like sit in between the LSP and the collateral token, and could do the unwrapping and then do the transferring on the user's behalf. And Kevin was just
Yeah.
saying, is that like really hard? And I said it's not too hard.
There's a lot of proxying going on. Like it would be annoying to write, but like it's possible. It would work a lot like an LP contract or an LP token would work, right? An LP token is effectively just wrapping different amounts of 2 other tokens, except that they're not in fixed. They're not like it's not like an LP token has like 1 ETH and 1 DAI in it. It's they vary, right? But like with this, it would just be fixed. So each one would be worth 1 ETH and 1 DAI, and then you would just need to do that. I don't know if like sitting in between the LSP and the collateral token would be right. It might be that you want to wrap around the redemption call so that the LSP works just like any other LSP would. It's just once you redeem, when the proxy that you're going through to redeem would basically convert the tokens on the way out.
Yeah.
Or something like that. But yeah, I think that's that's all totally possible. It's all just software. You can write anything.
Were there any other questions?
I guess I have another one.
Yeah.
In terms of like us running our own liquidity mining program, like with this, is that on the cards? Like, is this something we want to use internally and like grass feed, like test it out for something on one of our own products? Like, I mean, it's more of a strategy question than about liquidity mining 2.0, but I'm just curious, like, what the thinking is with that.
Yeah, I've actually thought about it. I never really talked about it with anybody, but I felt like we were still trying to figure out our whole developer mining program and the transition from that, and how we would pay rewards going forward after that, or if there would be rewards and if there would be a grant program. So we had all these other complications that we were thinking about. So we never really got to that conversation, but I think we should. I think if we want to really show people how it's done, I think it's something we should probably try to do. And I don't know what our exact metric would be. It might not be TVL, it might be something else. But yeah, I really do think we should probably experiment with it and try it out, and just to let people see how it works. There were projects that were close to doing something, so we were kind of working more on that and trying to let that be the first kind of showcasing or experiment. But yeah, I think if nothing happens soon, we could probably consider something like that.
Also be a nice opportunity to build some of the tools. Like if we try and think about like what are the lowest hanging fruit that we could build and then try and build it in a generalized way.
Right. I think do we have most of the tools already for what we want, or like we
In
have
some
redemption?
form, I think, but they might need to be changed to be more generalized.
I think we
Right.
want something a lot more like if y'all are familiar with like the Uniswap router, like I think we want something like that for LSPs probably. Like we want something where you generally go through this thing to talk to all LSPs, and it can have we can just have pretty sophisticated functionality there around wrapping and unwrapping through this trusted contract. So like I think a multi redemption would be really, really valuable, where like you have like all these different like KPI options that you've accumulated over farming into a few different projects, and you just want to redeem all of them. Like that could be, I feel like that would be like a really useful like way to both save users gas and also just like make things easier if you have like 5 rounds of balancers sending out KPI options every week or whatever, and so you have all these different, maybe you have different KPI options from balancer and stuff, and you just don't want to have to think about it. So you go in some UI, it says, hey, you have all these KPI options, would you like to redeem all of them right now? And you say yes, and it walks you through the approvals you need to make, and then once you're done with the approvals, it just it works. We could also
You wouldn't even need to approve, would you?
Well, if the wrapper had no permissioning, no initial permissioning, you would.
But our tokens don't need approval for burning though, for redemption.
They don't need approvals if you're talking directly to the LSP contract, but you're talking to the wrapper or the router, not to the LSP contract. So we could also even build in something special, and I don't know if Uniswap does this, but we could build in something special where like our wrapper or this router contract gets special permissioning to like pull tokens from users' wallets and stuff. And we kind of implicitly assume that is trustworthy, and then you could do all this with no approvals. You could just like have the users like burn the tokens all in one transaction with no approvals, which would be really slick and make and kind of take away a lot of this complexity that we're worried about.
Yeah, that's awesome, especially if it can like auto detect every single LSP that's expired across like multiple different programs. That's really, really nice. And if we build like this thing end to end, then it might even be able to detect like unclaimed tokens. If there's like a Merkle distributor for some of them, perhaps, right? Like you could figure out, okay, there are these that I can claim and then immediately redeem, which was obviously a bit of an issue with our KPI options. Like if people hadn't claimed them and then trying to redeem them was a problem. So yeah, we could like, if there was this like unified front end, we could control the user experience like a bit more, which would be cool.
So it wouldn't just be for liquidity mining; it could be for anything then. Like
for any LSP.
Airdrops, and that'd be kind of cool. That'd be really cool, actually.
Yeah. There's a lot you can do here to make this whole process a lot slicker.
Mm-hmm.
Like even on the distribution side, like I think that one thing a lot of protocols don't do that I think would be really nice as like somebody who's received some airdrops. I think a lot of people on the team have like other old wallets they've used. Like for instance, a lot of people had old wallets they'd use with Uniswap, and you actually had to go into that old wallet and retrieve those tokens, which is really annoying if you've like removed all the ETH out of it. So something that could be really cool for like a part of our distribution tool set is to like have a way where you can submit a signature from that old wallet, but actually tell it that you want the tokens to go to a different, like you can submit the transaction with a different wallet. So I just generate a signature with my old wallet and then copy over that signature to my, into Etherscan or something, and then send the transaction from my new wallet. And then the tokens get pulled into my new wallet, not my old wallet. So that way I don't have to worry about going through and putting ETH in all these old wallets and transferring tokens around and all that stuff. It just makes the whole claim process a lot easier.
Right.
I mean, that sounds super cool, but is that, that's probably a big burden to implement, right?
All these tools are going to be somewhat painful to implement. I'm just saying that there's I guess all I'm getting at is there's a lot of tools that are buildable that could make airdrops and liquidity mining and those sorts of programs a lot easier for the users, and potentially we could make the experience pretty much comparable. Well, hopefully we can make it somewhat comparable to the current user experience of mining, which is frankly pretty nice.
So yeah, so most of the tools you're talking about are cool, but that one where you allow someone to claim from other wallets seems kind of like a pure net cost. Like Uniswap did not want to drop you 400 tokens to 10 wallets, Matt. they wanted to drop you the 400.
Yeah, that was my first thought too. It's just like, because I've had like a couple of airdrops where I'm just like, oh man, I better check every wallet that I've ever had. No, actually, I actually disagree. I actually disagree with this a little bit, right? I think Uniswap Uniswap does not want their tokens sitting in that distribution contract forever and locked there. They want people to claim the tokens. Like they want the tokens to go to people. The alternative is they just sit in the contract forever. So like I think that Uniswap definitely wants people to get access to their tokens and doesn't want people to be like, oh, they're in this old wallet. I don't want to deal with this. So I mean, I don't know. But I'm really just like throwing out random like tools we could add. But there's the broader point I'm trying to make is that there is a huge swath of tools depending on the use cases we want to that other projects have, whether it's like DAOs for raising funds for treasuries, or whether it's like liquidity mining, or whether it's even airdrops. Like there's totally distinct and really nice tool sets we could add to make these KPI options perform like really comfortable for users, and hopefully really comfortable for the DAOs too, because that's another problem. Like if it's too, we've noticed, we talk about this a lot, but we've noticed that like in finding DAO, in getting DAOs to use some of these products, a lot of times the DAO will come in and they'll say, yeah, we're really excited about this, and they get about halfway through and it's kind of like it's a lot of effort, and then they realize that it's just going to be a lot of work, and they kind of either give up or like it doesn't ever quite get there. The conversion is kind of slow and just kind of putters out after a while. So I think like building the right tools to make this easier on everybody is a really good customer acquisition strategy.
Yeah, I would definitely agree. So will we use this mining idea for the insured bridge at all, or are we expecting? Like I think one of the ideas that John had was that a lot of DAOs would end up putting tokens in, so we probably wouldn't just be rewarding different DAOs with tokens, but like for regular users, would we actually have a mining program for that?
I think it's a good idea. I mean, the initial tokens that we're going to launch with are probably going to be like the tokens that Optimism has liquidity on, which isn't DAO tokens. It's going to be like Wrap Bitcoin, USDT, which are like the main ones that aren't on the canonical bridges, and ETH, obviously. So yeah, I mean, we might need to incentivize liquidity there, but yeah, because it's kind of important that there's sufficient liquidity for this thing to actually work properly. So it might actually be a prerequisite at some level.
Right. Yeah. KPI option. I think like it's exactly what we want. We're driving a certain activity, so we'd be happy to pay people more for more assets locked, I guess.
And I think to Chris's point, like focusing on those assets where there isn't some natural big pockets DAO that's sitting on a whole bunch of tokens that could easily provide liquidity at low risk.
Right, exactly. Makes sense. Well, I don't have anything else, unless there's more questions. I think it was supposed to be a short learning session anyways.
This is really cool. I really like those spreadsheets. Did you share that in Slack somewhere?
You can access it through the article for sure. But I can put it on Slack again.
I'll find the article. That's fine.
Yeah.
Yeah, this was super cool.
Well, yeah, it's just a spreadsheet. I only know how to make spreadsheets. I'm a business person.
Spreadsheets are code, Kevin.
Have
you heard of? I don't know if everybody's at this hackathon, but we went to a hackathon. People created Sheetcoin, which is a blockchain implemented on Google Sheets. Or not a blockchain, I guess, but like a token project built on Google Sheets, or Anyway,
Sunny made that, right?
Yeah.
Wait,
It's pretty brilliant. It basically allowed you to like deposit and withdraw to Google Sheets, which was like kind of a spreadsheet that implemented basic like Bitcoin-like functionality where you had like kind of accounts and balances, and so you could create an account. You could like kind of transfer money into your account, an account on Google Sheets, and then your balance would show up in the spreadsheet, and it would be locked on the other chain. So it's kind of like almost like a cross-chain transfer protocol combined with like a protocol built on Google Sheets. It was
Well, that's
it was
pretty
like
cool.
kind of it was actually like pretty amazing, like just that you could do it, but yeah, obviously somewhat useless too.
It sounds cool. I gotta check that out.
That sounds like ACH.
Yes, that's actually a great point. It is. They re-implemented ACH. That's how ACH goes virtual currency. Is they just hook up the Google Sheets APIs to a blockchain.
That's funny.
Yeah, but
before
the speed of ACH makes me wonder whether it's done by a person kind of entering it into the spreadsheet rather than automated.
Oh, 100%. That's the next innovation in ACH is they're going to have somebody on staff who writes code, and they're going to figure out that you can actually automate this. Before we hop off though, I wanted to ask, since we have a few more minutes, I don't know if we have a learning session lined up for next time, but I just wanted to see if anybody had ideas for other learning sessions that we could do.
I did have a bit of a chat with Chris about the potential for the cross-chain bridge and the insured oracle.
That sounds like a good one.
And
Yeah.
we kind of penciled that in for September. Do you reckon that that'll be about ready in a month to present on?
Cool. All right, then the question is answered.
Excellent.
Kevin, I had a quick question,
Sure.
but the problem is I'm not going to be capable of explaining the whole question super well. So someone had reached out to me in response to your post asking me about basically paying market makers through this mechanism. And he was referring to the fact that they pay market makers using options, I think,
Yes.
that they have to actually pay to exercise. Like, and so the reason I can't actually explain, I don't really understand that piece of it. So I can't really explain the question to you, but maybe you already understand how this relationship works with market makers.
Yeah.
And then the question is whether you think this kind of product would be useful for that.
Yeah, that's an interesting question. So with market makers, so anyways, actually, we should probably go up a step back first. So what happens is when you're a project and you want your token, say, launched on Coinbase or any exchange, what ends up happening is these exchanges will require a certain minimum amount of liquidity on there. So what the projects need to do is they need to find a market maker who's willing to commit to that, to ensure that they always have liquidity on these exchanges. There's different kind of fee structures that can provide this. So you could say to someone, okay, well, I want this kind of width in the market in terms of bid to offer and some kind of depth. Like, you know, in this width, I need to trade like, I don't know, $100,000 worth of my token. So they could, in one case, they could just charge you a fee. So every month they'll charge you a fee to provide that liquidity. But really, these market makers also want to trade and make money from all this activity, because in crypto there's obviously a lot going on and a lot of volatility. So what ends up happening more is that these projects also don't want to pay money because they don't really have a lot of cash. They would these market makers would say, like, why don't you just give me call options on your tokens? So there could be call options close to the market or above the market, and it does a couple of things. One is it gives them this kind of free call option now, which is obviously worth something. So they would say that this aligns their incentives together. If the market rallies as this token's launched on, say, Coinbase, then they would also make money, and the project's happy, and these market makers holding these call options are obviously very happy because now they've made a lot of money. The other thing that it does is that it allows the market maker to provide better liquidity. Because when you're, as most people know, if you're in a pool, say you're in a LP pool, you know that you're kind of short convexity, or you're short optionality all the time. So you effectively, if you're a long call option, you're long some optionality now. So if the market rallies, you could actually start selling the token, right? And then, because you know that you have an option to buy that token, and if the market sells back off and it goes below the strike, then you can start buying back what you sold. So suddenly you have this thing where people would call like delta hedging or gamma hedging, where you can buy and sell these tokens because you have this option now. So it becomes very valuable to the market maker. So I think, so basically that's how that business kind of works in a quick, like, kind of 3-minute explanation. But I think what the person's asking now is, can we provide something that's different? Because a lot of people think, oh, this is quite expensive. Giving away this call option to these market makers is very costly, because now they can buy a lot of my tokens and make a lot of money. And there's a lot of times where a lot of these market makers have made a ton of money, because they would get these call options, this token gets launched, and it just, like 3 or 4x's immediately, and then they're cashing in all this money now. And their incentives aren't really aligned anymore, because now the strike is so low, and the market's like much higher. So that optionality is kind of gone. It doesn't really help with anything. They've already made all their money. They're not incentivized to help any further. So I think the question is, like, how do we align that incentive better with, say, like KPI options or something like that? I think I need to think more about it. It's kind of tricky, because the KPI option doesn't exactly match the price action, and the market maker cares more about the price action, and they want that optionality in the movement of the prices. So there might need to be more thought about that. Also, at the same time, like, in order for these market makers, like, in order for this to work for the market makers, they also need to be borrowing their tokens, so that they will be borrowing those tokens, because it's hard for them to borrow tokens on something that's a liquid, and it's not really, and it's brand new, and get short them to capture this option value. So what ends up happening is they'll actually have a float of tokens to trade, which is why you'll see that, a lot of times people want to borrow our token as a market maker so they can trade it, because shorting these tokens are probably not ideal for long periods of time. But yeah, there needs to be more thought into this if you use KPI options. I think the idea is that, you want to reward market makers with something else that's linked more to the success of your project. But the other thing about it is, like, I'm not sure if the market maker is really incentivized to drive specific metrics of the protocol. Their whole purpose is just to basically manage the liquidity of that project token, not necessarily provide more to the project in terms of, like, expertise or yeah. So yeah, so it's a little bit different, but I think I understand where the question is coming from. Like, for a VC, it makes sense, because, like, if you're a VC investor, then you'll have something that can help the project succeed. But for the market makers, like, their whole job is just to provide liquidity for the token.
Cool. Thanks, Kevin.
Sorry, that was a really long answer. Yeah. Oh, sorry.
Kind of related, but yeah, just kind of related. But Jono from Yam had a cool idea for, like, Uma's next liquidity mining program, where instead of, like, paying out tokens, we would pay out options to liquidity providers that would basically try to compensate for impermanent loss. So, like, the more trading activity, or, like, the more impermanent loss on a pool, like, the more options the liquidity provider would receive, which is kind of cool and kind of related, because it's, like, providing options to market makers.
Yeah, that's kind of interesting. So you basically just track impermanent loss over time period, and then get paid number of tokens relative to that movement, or to that number, I guess.
Yeah, so effectively people could liquidity provide and never experience any impermanent loss because that's covered by liquidity mining.
Right.
And this impairment loss can be also like tracked as the underlying like price identifier. It's not only like one way is kind of solve it in distribution, just give more these synthetic tokens to users who experience more of this loss. But other option is also like to automate it and track and ask like the voters or proposers to actually check what was the impairment loss and to kind of handle that automatically.
Right. That's interesting. But they would get you would still get a positive return, I guess. You're not just covering for your impermanent loss. I guess you get your return just goes up as impermanent loss goes up. It's not like you're converting your impermanent loss into tokens, I guess.
Yeah, I think so. You would also like as your impermanent loss goes up, you'd probably get more fees from providing liquidity as well, and you're not experiencing any impermanent loss because it's covered by like the liquidity mining impermanent loss options. Yeah, and then there could also be like some like very small base liquidity mining fee on top of that. But I just thought it was like a cooler way to liquidity mine because like your liquidity is actually directly incentivizing or directly like useful other than just rewards to adding to a pool.
Yeah, that makes sense, especially for these synthetics because you don't really know how they move. There's a lot of uncertainty around that. I guess it would makes people feel a lot more comfortable providing liquidity for that.
Yeah, and it would only reward like more volatile pools, I guess.
Right. Okay, something we should definitely look into.
Thanks very much for that, Kevin. That was a really good introduction to the liquidity mining thing, and I'm so glad that you stepped in at such short notice.
No, that's no problem.
And thanks to everyone for attending. The session will be up on our YouTube fairly soon.
Great. Thank you.
Thanks,
It was a good
Kevin.
conversation.
Thanks, Joel.
Thank you.
Yeah, thanks everyone, and thanks Ari for organizing.
Thank you.
Thanks, Kevin.